House prices are rising significantly, but the rental growth hasn't kept up.
Affordability is what's really driving buyers at the moment.
I wish we were seeing more supply, and we're just not.
Someone who may have considered bringing new stock to the market may now not do that at all.
Welcome to the Melbourne Property Podcast. I'm Sky.
And I'm Lindsay.
And we're your hosts and Melbourne property experts. This podcast is your weekly source for insights, data and tips on navigating the ever-changing Melbourne property market.
Whether you're buying an investment property or your dream home, stay tuned for the next 30 minutes as we give you exclusive data and trends that will shape your next property purchase.
And please remember, this information is general in nature and should not be considered financial advice. If you'd like a more personalised conversation, book in a call with the Conversions Buyers Agents team and we'll take it from there. Now let's dive in. Hi, I'm Sky and welcome to another episode of the Melbourne Property Podcast. And today we are breaking down the monthly data. So we're going to run through Cotality's Home Value Index, or the HVI. We're going to talk about what's happening across Australia briefly, and then we're going to break down what's happening here on the ground in Melbourne. So it's one of our shorter episodes, but it's jam-packed with data. You're going to get some insights. And we're also going to touch on a few things that are hidden in the media at the moment, including potential changes to capital gains tax and to negative gearing. But as always, I'm joined in the studio by my co-host Lindsay. Lindsay, how are you today?
Yeah, I'm feeling pretty good. What about yourself, Sky?
Yeah, doing good. Yeah. Got a few podcast recordings today, different podcasts appearing on. So first of many, but obviously to kick things off, I do like to get into the data and see what insights Cotality brought us this month.
Yeah, it's a great way to set the scene, definitely, what's happening in Melbourne and all backed by data. Should we start with the win for the week, Sky? What was your biggest win?
My little win for the week was actually running into a podcast listener. I was just getting lunch midweek last week and had just someone kind of stop me in the street and said that obviously really enjoying the podcast. They've got me listening for, I think, over 12 months now. So it was good to just kind of meet someone. They've been looking to buy in Melbourne, initially a house to buy to live in, and then now kind of pivoting to that kind of potential rent investor and buying an investment property. So it's good to kind of meet a listener in person as opposed to kind of just the comments and stuff we get through social media for a change.
Key question, what sort of lunch were you grabbing?
It was a wrap for lunch. Yeah.
There you go.
Yeah. Very important question, I'm sure. But what about yourself? What was your win for the week?
Well, probably what's to come. It's my birthday this week and Formula One is coming to Melbourne. So I've never been before and I'm actually going to go this year, check it out. Someone recommended that I should watch, is it Drive to Survive, the TV series in advance. But being a business owner and a mum of two young kids, I haven't even got past the first episode. So who knows? Maybe I'll go, I'll love it, and this will be my new thing. Let's see. But yeah, just love what's on offer in Melbourne and that we can go to these sorts of things.
Yeah, the F1's definitely gaining popularity, obviously in Melbourne, but kind of globally as well. Thursday morning, I'm going to try and get to it if I can. You can actually run the track. I've got a mate they're going to probably do that with. So we'll get out there nice and early and run around the track, go for like a nice short stroll and check it out that way before obviously heading there on the weekend. So anyway, that's enough about the F1. As I said, we're going to break down what's happening in Melbourne and Australia briefly from a data perspective. So as I said, Cotality will release this report every month, the HVI index. Breaks down, I guess, the growth that the key regional markets, but also obviously the capital cities are experiencing in the last month. Rental growth, price growth, supply numbers, so the number of properties listed available online. We're going to run through that. I'll get Lindsay to do that in a second for, I guess, Australia and what we're seeing. And then we're going to break down into Melbourne. And there, as has probably been the case for the last 3 to 6 months, there's quite a clear divergence between places like Melbourne and Sydney and then those kind of mid-tier, capital cities in terms of Brisbane, Adelaide, Perth, etc. So maybe over to you and we'll kick off with the data.
All right, well, I might jump in. I have Cotality's report here in front of me. So property values across Australia rose 0.8% in February. Like you said, though, Sky, there does seem to be a bit of a divide between different capital cities. So those mid-sized capitals continued to record a solid rate gain of more than 1% month-on-month growth. And the weakest performers were Sydney and Melbourne. So potentially slightly less resilient to the February interest rate rise that we saw, maybe a drop in sentiment, those sorts of things. But both Sydney and Melbourne were flat over the month. So, yeah, I guess we always talk about markets within markets. We'll get to that shortly.
Yeah, and just to run through some numbers for comparison. So we've got, just looking through the numbers here, Perth at 2.3%, the property boom that just doesn't seem to stop. Brisbane 1.6% for the month, Adelaide 1.3%, Hobart 1.2%. But what I want to flag here, though, is quickly is just Darwin, because Darwin has been leading the charge. It's up 19.4% over the last 12 months, we haven't been buying property there. And we said from day one that there's going to be a lot of property growth in the next, say, 12 to 18 months in Darwin. That has happened. But it is quite interesting to see it's dropped down to 0.2% this month. I don't know if it's the start of the end for that property boom. It's very investor driven. It's not driven by owner occupiers. So it'd be interesting to monitor Darwin over the next few months to see if that's just a blip on the radar and it keeps growing again. But for now, it jumps out to me as the number that kind of strikes the biggest difference from the previous month.
Yeah, so if you look at Melbourne, though, for the annual growth, it's at 4.7% now. That's over the last 12 months. Stock levels are also down 4.3% on average in Melbourne.
Yeah, and we've seen that across the board, kind of all capital cities, but also Melbourne as well. Melbourne not as bad, I guess, from the listings perspective. Like you can see in places like kind of Perth, Adelaide, they're still down 30, 40, 50% on the kind of, I guess, 5-year averages, whereas Melbourne's kind of just sneaking in that kind of 4.3% on the 5-year averages. But again, it's one of those markets that I think there's markets within markets, and you've already said this once, and we do say probably too much on the podcast, but at the topper end, and just to give an example, at the topper end, we're definitely seeing more supply come to the market, and that's not just in 1 or 2 suburbs, that's across the board. But in the bottom end, I wish we were seeing more supply, and we're just not. So in terms of going out there, buying property in that sub 950K range, there's still just no supply. All the supply that's coming to the Melbourne market is $1.5 million plus. Properties sitting there, they're not getting much interest whatsoever, depending on the suburbs. So it is interesting to compare, I guess, the bottom end with the top.
Yeah, so if we actually take a look at what Melbourne's combined dwelling median price is, it is $826,132. So that's still the third most affordable capital city in Australia.
Yeah.
And it is still down 1% from the peak that we saw in March 2022 during COVID. That's for combined. If we break it down further to houses, the median house price in Melbourne is $977,579. And for units, the median unit price is $642,431. So I guess sitting at the third most affordable capital city in Australia, we are starting to see that growth. It's really just showing what's to come in Melbourne, particularly if affordability is what's really driving buyers at the moment.
Yeah, and I think we've spoken about this in previous episodes where I think it's not going to reflect on the data for some time, particularly as the top end of that market continues to lag. And I think it will even more with the rate rise we've just had and probably another rate rise in the coming months. The data is not going to be reflective of that. And we can break down a bit later on the different councils in Victoria and I guess which ones are growing significantly and then which ones aren't, because I think that really just kind of sets the scene as well for kind of which markets are moving here in Melbourne, but those that are really lagging behind.
Yeah. I also wanted to touch on gross yields. So the Cotality's National Rental Value Index rose another 0.7% in February. So that actually is continuing the accelerating trend that we've seen since October last year, where rents have continued to rise. So Melbourne's gross rental yield is now at 3.7%, and that's in the midfield compared to other capital cities. So we've got Sydney at 3%, Brisbane at 3.3 and Adelaide at 3.5. So they are all having lower gross yields than Melbourne, which is promising to see.
Yeah, and so like Sydney, like no surprise there, but it is funny to read about Adelaide and Brisbane having kind of those low yields, which again, with yield compression happening because obviously the house prices are rising significantly, but the rental growth hasn't kept up. So it's no surprise to actually see that there, but it is funny seeing kind of those markets really drifting in terms of the gross rental yield. So as I mentioned a bit earlier, it'd be good to break down some of the kind of pockets of Melbourne and what's happening from a growth perspective. And comparing those to last month, because there's going to be some that I just had a look at the list and there's some that kind of lead the charge, as we're expecting always. Some that were in the top 10 list for growth have now just disappeared, and there's others that are starting to slightly move up the ranks. So in February, no surprise, our dear friends in Frankston down the Mornington Peninsula, again, had the strongest growth over the last 12 months. So 12.9%. Followed by Brimbank, which again had 10.3%. So they're the only two in kind of double digits growth over the last 12 months.
And this is at that SA3 level. So it's not just Frankston, the suburb, it's the broader SA3.
Yep. Yeah, so generally like a council area. So going back to last month, Frankston and Brimbank again kind of topped the charts. So kind of no surprises there. However, we've now got Sunbury at third. So Sunbury's actually slid up that list. It was I think 5th or 6th on the list last month. It's now at number 3. So again at 8.5%, which it was kind of last month as well. So the growth has remained fairly consistent, but maybe some of the other months have fallen away. So rounding at that top 5, we've got Tullamarine, Broadmeadows as the area, and Kingston, that region as well. They're both at 8.1%, whereas last month it was Whitehorse East and Sunbury. So what we've seen there is Whitehorse East, that area, was 4th. It's now off that list. So it's really kind of dropped away there. So I'm not sure what's going on, whether that's had a really strong growth kind of 9 to 12 months ago and it's now dropped off, or that market is starting to pull back. So we'll have to do a bit more digging there. But a few other ones that kind of jump out at me as well is kind of Casey South has now popped on it made it into the top 10. We've been buying that area for a while now. We spoke a lot about kind of Cranbourne and surrounds and a few others that haven't been kind of at the top of these lists over the last 12 months, but we're expecting them to be as that growth picks up. So it's nice to see Casey South kind of pop up on the list, and Cardinia as well, to see that kind of make its kind of first appearance for a little while too.
Yeah, I think it's no surprise there to see a lot of these on the list though. A lot of them do sit within that sort of lower quartile. Sort of what price points have we got? We've got Frankston at 856,000, Brimbank at 730. There's a couple there in the millions like Kingston. But majority are sort of that sub $1 million price point.
Yeah. So obviously the other thing Cotality do when they release the report, obviously it's very data driven, but they do provide some commentary. So they talk about the market conditions, what's influencing the market across Australia. They don't get too specific in terms of locations, but are you able to maybe run us through, I guess, some of those key drivers and what we're seeing in the market right now?
Yeah, so according to Cotality, their view at the moment is that the overall housing market conditions in early 26 are quite balanced. So that's a good thing to see. Affordability does remain the most significant influence on the housing sector, and that is deflecting that demand towards the lower quartile, which is what we're seeing in the data. Dwelling values do remain elevated though relative to household incomes, and that February interest rate hike has further eroded borrowing power. So that has made it harder for some people to push up into that next quartile, and that's why we're seeing a lot of competition in the lower quartile as well. In particular, the average loan size for new mortgages is approaching that $700,000 mark. So if you look at that plus adding on any deposit people might have, that's still sitting within where we're seeing a lot of the growth happening in those SA3 regions at the moment. Income growth has weakened in real terms as well. So we've had wages growth falling into negative territory, and that's once it's been adjusted for inflation. So all of these things are contributing to how people are approaching the housing market and sort of looking at potentially more conservative buying, longer lead times and those sorts of things.
Mm-hmm. I guess from when the 5% deposit scheme was brought out and the changes that were brought into it is interesting with these interest rate rises that, again, it's going to be the first homeowners who the government, I guess, pretended to be helping in this scenario, and I guess it did help to some extent. But it's then they're going to hurt the most by these, I guess, interest rate rises. So instead of saying having 10 or 20% deposit, which would have been cash, and their loan amount would have been less, they've now got a higher mortgage. So they're now 95% LVR instead of, say, 80%. And they're the ones that are going to have to be forking out even more on these loan repayments. And again, unlike the investor side, who've got rent coming in to help with this, they don't have that. So I think it's going to be another one where people are stretching, they could probably get into a better quality house. But I would be surprised if this doesn't have, I guess, a more of an impact on them in terms of how much money is coming in at the end of the week or at the end of the month. Mm-hmm.
Before we continue, just a short note from our sponsor.
Property is a powerful way to build wealth, but knowing what to buy, where to buy, and when to act is where most people get stuck. If you're planning your next property move and want clarity, book a complimentary call with Sky Hammer from Convergence Buyers Agents. Sky works one-on-one with his clients using a data-driven approach and on-the-ground insights. He takes the guesswork out of buying and aligns every purchase with your broader strategy. And as a former diplomat, Sky knows how to negotiate confidently and get results. You're never left wondering if you overpaid or bought the wrong asset. To book your complimentary call, visit convergencebuyeragents.com.au or click the link in the show notes.
Are there any other sort of national property headlines or updates that you want to talk about today, Sky?
Yeah, so obviously the huge ones that are going around now are potential changes to the to capital gains as it relates to property, and obviously negative gearing is the most recent one. So they're everything's on the table by the sound of it with the federal government. Again, not doing too much to address the supply side, which is the issue that we have in this market right now. But so what they're talking about is changes to the capital gains tax as it relates to property. So if you go out and currently, if you buy any kind of asset, you hold that asset for 12 months. When you sell that, you get a 50% reduction on the capital gains. So that's just kind of a blanket rule. It sounds like they're going to keep that for things like shares and other investments. So they're not looking to change that, but they are looking to change it for property. I don't think it's going to have any major impact in the market. Like we are feeling that in terms of clients coming to us. Some are saying, I want to buy before these changes come in case they're grandfathered. And when I say grandfathered, I mean that if you already own 2 or 3 properties that are negatively geared and they bring in these new changes, they're not going to affect your property. And so again, it just kind of defeats the purpose of even bringing these changes, I think. But what realistically sounds like is going to happen is they might have a change from a 50% reduction in the capital gains to a 33% reduction, which again is a nominal amount. And I'm quite outspoken on some of these policies, but for this one again, it's just winning votes again. Like it's not actually going to change the market. It doesn't improve supply. And if you're an investor, let's say like one of our clients who come to us and say, I want to buy an 800K property for the long term to get the best capital growth I can to kind of give myself and my family options in the future. They go out, they buy that 800K property, it doubles to 1.6 in 10 years. They're quite happy with that 800K capital gain they've made. And whether it's they get a discount on 50% or 33% or no discount, they're still going to come out a lot further ahead. So it's not going to impact people's decision to go and buy an investment property. For those maybe kind of that listen to the media a lot more, it might, but again, generally speaking, over that 20-year period, there is going to be probably multiple governments who are going to impact and have changes on negative gearing and capital gains tax anyway. So it's going to change. So I wouldn't be too kind of held up on what's happening right now. So that's one take on it. The negative gearing piece, I think, is quite interesting as well because, again, it's not going to fix the issue, which is around supply, and that's not going to change anything. And again, when they've spoken about changes to negative gearing in the past, it hasn't landed well. This time it's been a bit more nuanced. And so what you're seeing now is potentially negative gearing's only going to apply to the first 2 properties you own. Now, again, if you're a young person looking to get into the property market and you at any point in the future think you're going to own an investment property, build out a portfolio, I'd say the younger demographic are the most pro this at the moment when they should actually be the most against it because all you're doing is kind of handcuffing yourself and not giving you the same kind of benefits and opportunities that the baby boomers, Gen X, Gen Y, everyone else before them has had. Because let me just give you, I guess, a quick example. If you own 2 investment properties in personal name, you're obviously doing pretty well and that's great. But if you're already looking to buy a 3rd property, you're probably not buying that in personal name unless you're a very high income earner. And so what is most likely happening, you're probably already exploring different structures. So that could be buying a trust structure, company structure, whatever it might be. But let's say you got a house and 2 investment properties that are negatively geared now. Your borrowing capacity is going to be tight. And so what you've probably done is buy it under a trust structure. And in that trust structure, you don't get negative gearing benefits anyway. So like when they say it and say, oh, we're only going to cap it at 2, most savvy, clued on, I guess, investors with accountants, mortgage brokers, financial advisors helping them out, buyers agents, they're not going to be impacted. So again, it's just this kind of narrative that's being spun. They're going out there trying to win votes, trying to be seen to do something to fix the housing and affordability crisis. And this sounds great because it sounds like it's targeted at those mean, scary investors and boomers that own 50 properties. These changes aren't going to impact them whatsoever. And it's going to have no impact on the housing market in terms of affordability and in terms of bringing new supply to the market.
I would actually say it could even make the supply issue worse because if an investor has a property and they can no longer have the capital gains discount, at least not to the same extent, they may just choose to hold on to that property and not sell it. So someone who may have considered bringing new stock to the market may now not do that at all.
Yeah, exactly. And the changes, I've posted a bit on my social media about some of the other government changes that we're seeing. The one thing that I have heard recently that actually sounds useful was in South Australia. And I should do some content on this, but it was what they're talking about and actually addressing one of the core issues is for downsizers, if they're sitting in their $1-2 million house, it's too big because all the kids have moved out, instead of charging them stamp duty on the next purchase, they'll actually waive stamp duty if they go out and buy a a new dwelling or build a new dwelling, which I think is great because we see this a lot that downsizers don't want to sell their house, which they generally don't have to pay capital gains on, but then go out and buy another $1 million house and they're being charged 50, 60 grand stamp duty. And they're like, you know what, instead of just giving that money to the government, I'm just going to stay in my house. And so what it does, it reduces supply. So there's not that natural kind of turnover in the market. And there's no new properties being brought to the market. Whereas this incentive I actually like because it addresses supply and addresses one of the core issues at the moment is kind of the older generation staying in their homes and not selling. So it's not all doom and gloom. There are some people out there in different states doing some really interesting things, and I like that policy. But these current changes at the federal level just I don't see how they can address any kind of issues we have in the market right now.
Thanks for those insights, Sky. Really, really interesting. I also wanted to mention a bit of prop culture.
Sure.
This is probably up my alley more so than yours, but the block kicks off in March. So the next season's kicking off. It is being filmed in Mount Eliza on the Mornington Peninsula. So hopefully something a bit more relatable. There is that owner-occupier demand there in Mount Eliza. We've actually got another episode coming up in the future where we do touch a bit more on the owner-occupier demand that we're seeing in Mount Eliza. So hopefully it's sort of something that's a bit more relatable to what people in Mount Eliza are trying to do.
I'd say relatable to people in Mount Eliza.
Yes.
But again, I reckon they're going to be doing the same thing where they build $3-5 million houses they're looking to sell. So I think for Mount Eliza, that's relatable. Is it relatable to the mainstream viewer? I guess we'll wait and see. And I actually had Herald Sun had someone interview me last year about what I thought about the block. And again, when they're building these multi-million-dollar houses in Dalesford of all places, and surprise, surprise, they haven't sold or haven't done very well. Mount Eliza, despite again going kind of big and luxurious, it's a right market for it. Particularly, I've seen the site, and it's obviously close to the water, and it's going to have, I guess, some really strong appeal for owner occupiers, but also investors, holiday homes, all that kind of stuff. So we'll wait and see. I still want them to go out and do the Frankston, Cranbourne, Geelong kind of version of it, where they're building $800,000-$900,000 houses on a budget. It's actually what people want. It's actually what people are buying. Like, I think it'll do so much better. And again, when they do come out and do that in a few years, I'll claim credit for it. But I think right now people are just obsessed with these kind of high-end renovations because it's maybe detached from their own reality, or it's interesting what it is. I don't know. I don't have time for it. I'd much rather see a bit more kind of hands-on or realistic renovations. But who knows? We'll wait and see what they come up with next.
We'll find out. Mm-hmm. Very good. Well, that is a wrap for our February Melbourne market update, largely based off the Cotality Home Values Index report that was released overnight. Do you have anything further to add, Sky?
I think that's it. Yeah, as I said, we'll do these monthly. They're going to be shorter episodes just because we want to kind of keep you abreast of what's happening in the Melbourne market, but also at the national level. And we obviously will throw in some of insights as to what's happening in terms of government policy, changes to anything property related, or some prop talk.
Culture.
Prop culture. Okay, yeah, prop talk and not prop talk. So yeah, we'll keep it nice and short and sharp, and then we'll kind of dive into some other content again very shortly on the next episode. That's a wrap for this episode of the Melbourne Property Podcast.
If you loved it, hit subscribe and never miss your weekly dose of Melbourne Property Chat.
Please remember this information is general in nature and should not be considered financial advice. If you'd like a more in-depth conversation, book in a call with the Conversions Buyers Agents team and we'll have that conversation with you. The link is in the show notes.
Catch you next time and happy house hunting.